Hey everybody, and welcome back to the channel. I hope everybody's had a good week investing out there. I know that I've had a pretty good comeback this week with a 2.59% return on my M1 Finance account. My growth stocks are really bouncing back. It's been a pretty rough month for them. Um, but yeah, my Robinhood account, it's up 1.47. It's not doing as good as it could be. Had some bad news later on in the week from Corsair with some supply chain issues, but that's to be expected with the chip shortage and everything right now. So last week I mentioned that I would kind of go into more detail about which ETFs I've chosen and why I've chosen those ETFs, as well as some of the stocks. I'm going to go ahead and start on M1 Finance. They're where I keep most of my investments. So let's go ahead and start with the growth ETFs. In here, and I did explain these in my last video, the percentages in M1 Finance and how I invest in these. So I guess I'm just going to go into detail for each ETF and why I've chosen them. So starting with QQQ here, I'll show you how I like to look at it through M1 Finance. If you click on it, this is actually, my total return, which is obviously not too good yet. But if you look at the QQQ details down here, it'll take you to the performance over the last time period. You can choose your time period here. So I like to look at the 1 year, the 2 year, the 5 year to kind of get a good just gauge on how this ETF has actually been performing. 1 year is 26%. I think anything around 30% in a 1 year is excellent for a growth ETF. The 2 year absolutely outstanding with 94, and a 5 year is 225. I like to divide this up, into 5 years. It's not a realistic approach because 1 year you may get 100%, 1 year you may lose 20%. But anyway, I like seeing this is an outstanding performance over a 5 year period. And M1 does give you a somewhat profile down here, and they're not the best, and I'll show you why. If you read this description, you can come out of it kind of confused about actually what it does. So that's why I like to go to the actual website. If you read this, it says it generally corresponds to the price yield performance of the NASDAQ 100 index. To maintain the correspondence between the composition and weights of the securities in the trust, blah, 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 adjust the securities from time to time. It does have, how many holdings. I do like that. The maintenance requirement is quite high for this one, but that's all it really gives. And that maintenance requirement is actually dealing, I believe, with margin M1. That's actually not the expense ratio. So let's go ahead and move to the actual website for Invesco on this, and you'll see a little bit more granular detail. So the first thing you'll see is it's the number one highest rated. It's the 100 top 100 Nasdaq companies. Okay, that's a little bit more, and it's getting us a little further there. But I like this right here. The index includes the 100 largest non-financial companies listed on the Nasdaq based on market cap. Now we're actually getting granular. If you roll on down here, it'll get to where you can actually see the top 10 companies. You can see all the 103 companies. So if you come down to the fact sheet, that's what you're looking for, and you can see all kinds of fun information here. But what I'm here to look for is the top 10 holdings. On here it says 102. So if M1 says there's 103 and QQQ says there's 102, there's 102. Or Invesco, the actual website, says 102. And these top 10 holdings are super important to me to kind of tell me uh, several things, actually. I can see that, of course, your big tech, it's big tech heavy. I mean, it's the top 100. So, but also look how heavy they are. If you look here, we've got a good, what, 30% in the top three companies. That's pretty big. But also where it gets interesting to me is these companies right here after your, classic big tech. You got Tesla coming in, NVDA, and more Google, PayPal, Adobe. So I kind of keep those in mind as well. This list is not, you can also go back out here to Invesco QQQ and look for the entire list, I do believe. Let's see, yes, right here, QQQ product details for a deeper dive. That's what we want to do. Go to portfolio. You can see, it's going to show you the top 10s again, but you can click this view all button if you get nitty gritty. You can see the percentage of fund. I believe, yep, it's already sorted, so you can really get down to make sure you're not, if you're not one to invest in the same companies with the same ETFs, this is where you would want to go. Alrighty, that's enough about QQQ. Let's move on to another one here. I do have all these guys bookmarked. I love to check them out from time to time. Oh, wait a second, I'm still here. M1 is really every 5 minutes it's gonna make sure you're still here. All right, so you go to ARK here. All right, so if we go to ARK, oh, this I love this page. That this look amazing. All right, let's look at a little bit about what ARK does. I love their little fund objective here in the fund description. ARK is an actively managed exchange traded fund that seeks long-term growth of capital by investing under normal circumstances, primarily at least 65% of its assets in domestic foreign equity securities of companies that are relevant to the fund's investment theme of disruptive innovation. And it needs to describe it for us, which it's very helpful. As the introduction of a technologically enabled new product or service that potentially changes the way the world works. Companies within ARK include those that rely on or benefit from the development of new products or services, technological improvements, and advancements in scientific research relating to the areas of, and it lists them here: DNA technology, genomic revolution, automation, robotics, and energy storage, artificial intelligence, and the next generation internet, and fintech innovation. This differs greatly in the last one. You're not going to see lots of big tech in ARK, and I will show the holdings. So let's go ahead and go up to the fact sheet here. All right. All right, so let's come down here to the top 10 holdings as usual. Tesla. Now you did see Tesla in the top 10 of the other, but it was like number 6 or something like that with only 4%. It's 10% here. Roku. I mean, that nowhere in the other one, I believe. I mean, it could have been down there, but Teladoc, Square, Zoom, Shopify, anyway, Coinbase, Spotify, and Unity. So these are kind of like the new kids on the block. And all my investments are long-term investments. I'm not one to buy and then sell in 6 months, and to think that I'm going to be in the innovative area. ARK is going to keep me there, and it's going to keep trying to invest in companies that are going to change the way the world works. Those companies are going to be around a long time. So one thing about ARK that some people don't like is that it is a quite large expense ratio. It's the biggest one that I have. I'm not gonna lie. The Vanguards are really small, 0.03 on to 4 on most of them. This is quite large. But quite honestly, guys, the 0.75 in the long run, yeah, it's going to eat some money. But if you come back to M1 Finance, I'll show you why that really doesn't matter to me. You look at the 1 year; it's had a rough year. It really has. But 2 year, I mean, goodness gracious, 5 years, man. I mean, it's the top performing ETF that I have by far. The 0.75 to me means literally nothing if I'm getting these kinds of returns. And something I also wanted to kind of show you as well is the holdings. It's very focused, 49 companies. I believe that may be the lowest amount of holdings in an ETF that I have. All right, so that's enough about ARK. Let's go ahead and move on to the next ETF here. I believe that's going to be VUG. I'm going to skip VTI for now. It's more of a total stock. It's not really considered a growth. So I'm going to press on into VUG. I like to let's look at the performance, of course. 1 year, 26, on par with the QQQ. Your 2 year at 81, which I believe QQQ was around 96, so it's still hanging in there. And then 186, I believe QQQ was up over 200. This is still, I mean, this is Vanguard's flagship growth ETF. I mean, it's still amazing. 286 holdings, I believe. The other one said it's, the top 100. It varies 100 to 103. So this fund does have a little more holdings. You are a little more diversified. I like that. I also like to, and I will show you here, the expense ratio is amazing, 0.04. That's none of your money. If we come in here, I believe this guy, I didn't go over his expense ratio, which is actually, I believe, quite large, 0.20 right here. So it is quite large compared to the VUG. But this guy, if you look at his portfolio, look at his top holdings, well, let's look here. You're going to see some very similar holdings. Of course, Apple, Microsoft. I mean, it's very similar. I don't like to put, and the reason why I've got money in both of these two is I don't like to put all of my ETF money in one basket, if you will. Well, not with it, all of it Invesco, all with VUG. I just like to be a little bit more diversified there as well. Since it is so similar, I'm going to go ahead and press on to the next ETF, which I do believe that was VTI. Let's see here. All right, VTI. This is a total stock market ETF, and it's not going to have near as good a growth. Actually, it's had better growth than the other two. It's just, it's not shocking. Here lately, our value stocks have actually been outperforming growth stocks until this week right here. So let's look here though. 2 year, you can see it dropping off. Others were 80, 90. 5 years, quite a bit lower. What this ETF does for me, it keeps me in everything. Its holdings, wow. It's not 49 like ARK. It's not 100. It's not 200. It's 4,000. I'm invested in it. If it's in the U.S. Total Stock Market Index, I'm there. And another beautiful thing, it's Vanguard. Look at that expense ratio. Gives it a good little dividend. I have not been going over dividends. I do apologize about that. I do believe VUG throws a little bit of a dividend. So let's back up and look at that just real quick. We'll take just a second. Yeah, VUG, here we go. So a little small dividend, but it's there. All right, so let's move on to the last two. I do believe there's only two more. Yep, we have a VUG, yes, two more. So mid cap and small cap. Okay, these are going to get me in companies that these aren't, besides VTI, of course, it's total market index, but these get me a little more focused in mid cap and small cap. I have seen through my retirement plans at work and stuff like that, I have seen mid cap and small cap actually outperform large cap in certain years. So I just want to be a part of that, just a little bit more diversification. It's not a whole lot because most of the time these guys do not outperform your QQQ, your ARKs, your VUGs. But nevertheless, let's go ahead and take a look, and you'll see there's a ton of companies in each one of these. So VOT, we have a point. It's a little bit more expensive. I do believe, it's got a little bit more holdings than you'll see in, like the QQQ. Dividend yield's pretty far down there. But it's your mid cap. If you are actually to look at these holdings, I know DocuSign, but a lot of these holdings in mid cap, I don't know them personally. I think they swap in and out of these quite often, and I do believe that's why there is a 0.07% expense ratio, unlike the high flying big tech, large cap, those stock, they are seldomly moving in and out of those top 10 companies. So I do believe that's why that expense ratio is up just a little bit there. So let's back up and look at the small cap. It's going to be pretty much the same explanation here, but we'll just go ahead and make sure everything looks like we think it should. Yeah, around the same. Yeah, so it looks good. A lot more holdings. There's a lot of small cap companies out there, I'm sure, entering and leaving this ETF, so that expense ratio, once again. But like I said, these are, not a huge significant portion of my pie here, 10% and 10%. I did start out with 20% of ETI. That's what this top number, by the way, if you don't know, is that's what I have invested into this pie, and that's what my allocation is going to be. So when I start buying any of these ETFs again, it's going to be trying to buy these guys heavier since I'm not yet to my allocation. But you can see about 30% is going to keep me well diversified here. So you got 50, and so you got 70% that's going for, in my opinion, full growth right here. So let's back up. That pretty much covers my growth ETF section. My growth stock section, I'll hit on it for just a little bit. You're going to see a lot of the same companies in here that you were seeing before, and I just wanted to give them a little bit bigger piece of my pie. This is something that I like to manage myself, that I need to be able to pick some stocks, and these companies right here are beautiful. I can't say anything bad about any of these companies. I am going to be lowering my Facebook a little for my personal preference. I think that, and I could be completely wrong about Facebook, and I probably am, but I'm probably going to push them down to 5%. There's another few companies that I'm wanting to add here. And in the next videos, I may be actually, getting into those other few stocks that I'm wanting to add here and go into the reasonings behind that. All right, let's back up and look at the last portion of my portfolio here, which is my dividends, my value stocks, and my income stocks. All right, let's go ahead and start with Schwab. I love it. pays a great dividend. I've actually already received the dividend, and I just started investing in these guys here, not too long ago. So that's awesome. Look at that dividend yield. That's a beast. Expense ratio low. Love it. You can read the investment seeks to track closely as possible for fees and expenses total return of the Dow Jones Dividend 100 Index. And also to pursue the goal, the fund generally invests in stocks that are included in the index. Index is designed to measure the performance of high dividend yielding stocks, U.S. companies, that have a record of consistently paying dividends. All right, so this is going to get me, I like this portion of my portfolio a lot. I have pushed it down a little bit right now because value stocks are actually doing better than growth stocks up until this last week here. So M1 does give a little bit, 2 top holdings. I want to see just a little bit more than that. So let's go out to the actual website here. All right, so the fact sheet. Let's look at the top 10 here. All right, that looks nothing like anything that you've seen prior to this. I mean, I don't see Apple. I mean, you've got top paying Merck & Co. here, Home Depot, Texas Instruments, Broadcom, AMZN, PepsiCo, people that's been paying good dividends, value stocks here. I love it. I also would like to look at the growth rate on M1 Finance to kind of show you where this one falls compared to our growth stocks. So let's look at the 1 year. 35% outperforming all the other growth stocks right now. So 2 year though, I mean, it's all right, pretty good for also paying a hefty dividend here. 5 years though, you're starting to go, okay, yeah, I can see why it's not growth. Okay, it's not 500 like ARK, But for me, it's still worth investing in. I love getting these dividends. M1 automatically puts these dividends right back into my pie, which is beautiful. But all right, let's go back to also 104 holdings. So it's not tons of dividend stocks. It's the top dividend stocks here. All right, let's go back to the next one here. So looks like that's going to be VTV. Okay, so let's click on this guy and see what he looks like. All right, let's go into the VTV details. All right, 1 year, 32%. Awesome. Value stocks that are going up 32% in 1 year. How beautiful. 2 year. All right, you're like, oh wait, Kate, that's pretty poor. I'm not gonna lie, for 2 year, most of our growth is this year. All right, so 5 year, 85%. So you're going, okay, yep, not a growth stock either. Beautiful dividend though, beautiful expense ratio, quite a bit more holdings. We'll also got the BTV website here, and look at the portfolio management. Back click it. There it goes. All right, so let's look and see. JP Morgan. So you're seeing a little bit different value stocks. These are the large cap. If you go up to the actual, I'll go back to it. When you go up to the actual definition or summary of what this actually is, you'll see that these are extremely large cap stocks. So that are also value stocks. But these are quite a bit different than the top 10 of the SCHD. So let's go back and take a look at that. And right here, the large cap value index that measures the investment return of large capitalization value stocks. All right, so like I said, these guys here, they're not for the high growth. They're for kind of stabling my entire portfolio for that diversification. All right, let's look at the last one. I believe it is the last. Yes, JEPI. Oh man, this, yeah, I absolutely love this JP Morgan Equity Premium Income ETF. It's just amazing. And I'll show you why. JEPI details. All right. So look at that. That is amazing. Okay. This is also paid monthly. Okay. Obviously, this is an annual yield, so you'll get paid, 12 divided by 7.15 per month. But getting paid monthly dividends, it's just it's an amazing feeling to look down at your phone, you're in your M1, and it says, hey, you've received a $12 dividend. I believe it was $13 this last one. I've gotten, I believe, let me see here. I've got 2.3K and I'm getting $14 a month. That's beautiful. So let me explain a little bit more about JEPI. Seeks current income while maintaining prospects for capital appreciation. Let's see if this one does it justice. No, it does not. This does not explain it. So 102 holdings. I'm going to show you a little bit more about them on their actual website here. So let me get that up. Normally I already got this up for you. Hold on. Alrighty. So let's look and see. Okay, so to give you a little bit better idea, generates income through a combination of selling options and investing in U.S. large cap stocks, seeking to deliver a monthly income stream. To me, this is very safe. I mean,
Well, in my U.S. large cap stocks, I'm not worried. I mean, if that goes down, we're all in a bad way. But yeah, so this guy is my dividends. I mean, I'm gonna be putting more money into this. I may, if I receive some kind of extra money, I'm probably going to buy a little JEPI. I really enjoy seeing those dividends come in because when I get that $14, that's automatically put right back into my pie and investing in whatever I'm telling it to invest in. And I like to change these percentages up based on what I feel is best at the moment, and especially these. You'll notice I'm 58 and 60 here, so I should be 60. I'm 58. I've put more money in growth stocks. They're not doing as well right now as they normally are, so I'm buying more. I've moved this down. I don't want to buy my value stocks. They're doing great right now. Even though I love them, I love the dividends. I'm focusing more here. So I'm gonna so every week for the past few weeks, I've just been hammering the growth stocks to try to get that back up and going. Because every minute I buy low here, I mean, I these stocks, they're gonna go back up. And I mean, I've made, let's see, this is all so 14%, 3%. Uh, Down quite heavily on Facebook due to all the stuff that's been going on with them. But at the end of the day, I do believe in these companies. Maybe not much Facebook as much. I will be reducing this one probably to 5, maybe even 2%. It's a personal preference of mine. I will be adding, like I said earlier, 2 more stocks into here. I'll be sharing those most likely in the next video. But yeah, that's pretty much my portfolio in a nutshell. I went over the percentages in my first video. I kind of want to go into more depth on each one of these holdings, kind of giving you a little bit better idea of what they are and why I've chosen them. I love this strategy for long term. I think it's going to be amazing. And I just started this approach, a few months back. I had been playing around in the stock market here and there in Robinhood, and I actually even had a Fidelity account. So I'm like, no, I want this to be consistent. I want to be long term. I expect, because look at this. This is all time. I'm down because I've just started a few months back, and a few months back everything was going great, and then this last month everything's kind of went down. So, but a year from now I'm going to be looking at these, and I expect to fully see green, way up. There's not going to be anything, unless the whole market tanks. I expect to see green everywhere here. But anyway, guys, I appreciate y'all joining me for today's video, and I would just ask if you like the content, if you want to subscribe, that'd be great, and smash that like button would be awesome. Appreciate it, guys.